Hey guys, Alex Cook with Avon Mortgage Minute. Today I'm going to break down the different loan programs that we offer and some of the pros and cons to each. I'm going to try to keep it brief, just a brief overview over each type, because if I get too much into the weeds, I know it's going to be even more boring than a mortgage video can be. So, the gold standard loan is a conventional loan. If you come to me and you have a good credit score, you have money for a down payment, then that's most likely the program that's going to work best for you. The reason why is because it's accepted everywhere. You know, every seller, every realtor is going to be accepting conventional loan offers on their homes. And also, once you own 20% of your home, which means that you're at or below 80% loan to value, then you don't have mortgage insurance, which is an awesome thing. Mortgage insurance is insurance that you pay for that the bank benefits from. So basically, it means that if you default on your mortgage, it's going to protect them, but you're the one that pays for it. So after you own 20% of your home, the reason it falls off is because basically they say, listen, this person owns 20% of their house. They're probably, with this much skin in the game, they're probably going to keep making their payments. So that's why making a 20% down payment with a conventional loan is such a popular way to go. Not everybody can do it. Now, on a $100,000 house, that's 20 grand. So that's, a considerable amount of money. Unless you're selling a house and you have equity that you're taking from that house, you probably aren't going to do that on your first, especially on your first purchase. A lot of people aren't going to have that kind of money. So you can do 5% down, you can do 10% down, you can do 15% down, whatever you want. Obviously, the more you put down, the faster that mortgage insurance is going to fall off, because it has to fall off legally once you get to 78% loan to value, which means that you own 22% of the house. So again, on a $100,000 mortgage, once you only owe 78,000, then that mortgage insurance has to fall off legally. Your bank has to remove it. But on a conventional loan, the other cool part is if you're a first-time home buyer, you can do a 3% down, which is pretty huge. If you are not a first-time home buyer, you have to put at least 5% down. So conventional is the gold standard loan. That's the program that 90% of the people are going to go with. Maybe 99% of the people are going to go with if they have good credit and if they have money for a down payment. Now, if your credit is less than stellar, you're probably going to be looking at an FHA loan. The benefits of an FHA loan is that you can qualify typically with 580 or higher. Now, during COVID, we've had some overlays. Pretty much every lending institution across the country has had to raise that limit to 620 for the time being. So hopefully we see that go back down to 580 so that we can help more people. But banks are a little nervous in this time with people losing jobs, so they've raised the credit limit to 620 for now. But still, anybody over 620 that wouldn't qualify for a conventional loan, FHA is a good program. There is an upfront funding fee, which costs a decent amount, and also you have mortgage insurance forever. So that is a downside of an FHA loan. Upside is less than stellar credit. You can still get into a house. Next, I want to talk to you about a USDA loan. USDAs are actually a pretty amazing loan. The number one reason why somebody would put you into a USDA loan is if you have no money for a down payment. So I've seen this a lot lately, actually. Like I said, amazing program because the interest rates attached to those lately have been unbelievable. Rivaling, I don't know if I can edit that out, rivaling that of a conventional loan as far as interest rates. Absolutely amazing. The underwriting process is a little bit longer because we have to kick it over to USDA after our underwriters look at it, and then it has to sit there about 7 to 10 days until they get a chance to look at it. So not a huge deal, but if you're on a tight time frame, sometimes that kind of sucks to wait for their additional underwriting time. The only downside, well, I'd say two downsides to a USDA loan, is that you have to be shopping in an eligible area, which around where I live is almost everywhere except some parts of Goshen, South Bend, are not eligible. I send out my clients a locator, a little map they can type in the address, and it tells them if they're eligible or not. So that's one drawback. The other drawback is you have to have at least 640 credit. And also there's an income threshold. So you can't make over a certain amount of money to be eligible for USDA loan. Also, there's mortgage insurance forever on a USDA loan. Other than that, really, really sweet program. Last, I want to talk to you about a VA program that is for veterans, and that is a really, really, really cool program. I love it. It's kind of near and dear to my heart because why not give something special to those who have fought for our country, right? So they come back and they deserve to own a slice of the American dream that they've fought for. So I love the VA loan. Zero money down, no mortgage insurance, and also there's eligibility requirements are a little bit lower. So some vets that I've helped out are able to get into a home that they otherwise wouldn't qualify for based on income and the debt to income ratio. Couple downsides to the VA loan is that there is a stricter appraisal process. There's actually a stricter appraisal process for all government loans. So USDA and FHA, you're going to have a little bit of a stricter appraisal process. They are going to be picking apart things like even paint that's peeling. They're going to complain about, whereas on a conventional, they'll overlook some of those things. So the government's trying to protect you by a stricter appraisal process, and sometimes it ends up kind of being more of a nuisance. So that is one thing that's kind of frustrating to me about VA loans that I've learned, is that they're kind of discriminated against sometimes. Like, a lot of sellers won't want to accept VA offers because they know their house is going to get picked apart and the chance of the deal falling through is increased. So again, the government trying to kind of look out for the vet, but sometimes it ends up backfiring because the vet's like, hey, I want this house. I don't care if it has peeling paint, but ends up, messing up the deal. So all great programs for different purposes. Again, going back to the gold standard, conventional is something that everybody's going to love to see. A seller's agent is going to love to see that offer because the appraisal process and the chance of the deal falling through decreases dramatically. So anyway, I hope this helps you guys. This is, like I said, one of the most fundamental things that I run through with every buyer that comes to me to be pre-qualified. And there's always a ton of questions. So that's just a quick run through. If you have any additional questions, you want to know about income thresholds, or which loan program is best for you, please reach out. Whether you end up using us or not, I don't care. Honestly, I would love it if you become my client. Even if you know you're using a bank or somebody else, I still love to just teach people and to talk to people about what I think is best for them. So please feel free. It's free to reach out, ask me any questions you want, and hopefully it helps out. So if you have any questions, you can send me a message or email or call, and I'd love to help you from there. So have a good one. Thanks.